So welcome everyone to our new Advancio Tech Talk, where we invite experts in different fields such as fintech and logistics, bringing their perspectives with engaging discussions and as well as insightful topics. And today, I'm pleased to welcome Philippe Taliaferro, Senior VP of Saas from Lendio, and Abby Sleigh, data scientist from Lendio. So thank you, Abby and Philippe, to be with us today and to hear your perspective about how advancements in digital experience and data science are driving new growth frontiers in small business lending. So please let me first ask you, can you tell us a little bit about Lendio and the evolution of your business? So I don't know who wants to take the question
absolutely. First. Arnaud, thanks for having us. We're really excited to be here talking about a topic that's deeply passionate for the people at Lendio, and that's small business lending, and in particular how digital technology advancements and data science are changing the way that market works. Just a little bit about Lendio. We're the country's largest marketplace for small business loans. We've been around for about 12 years, and we have roughly 500 associates located in offices in Utah, New York, and Texas. Each month, we're funding roughly 10 to 15,000 loans, and we work with 75 lenders. Lendio is not a lender itself, but rather we are a technology and marketplace business that connects borrowers and lenders. Over time, that business, which started out mostly as a facilitation and workflow type of business, has grown into much more of a tech-driven business. We've built out a proposition around lender SaaS, which enables lenders to pre-qualify and auto-decision loans. We're making huge strides in embedded finance, where we're establishing proactive offers and lending capabilities directly at a point of commerce. Often those are underwritten using merchant transactions, and this is a big improvement over borrowers having to go out and seek loans independently. Those innovations, and really a common theme for today's conversation, is how data science is being used to drive innovations for both borrowers and lenders. So thanks again for having us, and we're really excited to get into the discussion.
Yeah, thank you, Philippe, for sharing more about Lendio. And actually, that's a great segue to start, deep dive. And my first question actually to you is, how specifically are you and your lenders using data analytics to support loan decisions?
Yeah, that's a great question and really timely and aligned with many things we're doing. So I think one of the most interesting things that we're doing is we are enabling lenders to anchor their decisions on transaction and cash flow analysis. Let me share a little bit of background on why we're doing that, and then Abby will explain a bit more about how it works. Firstly, it's important to recognize there's an emerging body of research. Most recently, an article or research paper by the Bank for International Settlements, but there have been many others, that explain how the use of transactions rather than traditional credit models actually expands credit access for businesses that have been in shorter time in business or located in developing communities, so those communities with higher unemployment and higher crime. There's also research that indicating this type of borrower, meaning less time in business in emerging places, that underwriting using transactions is a much better gauge of loan performance than the use of traditional credit scores. So fintech lenders actually have been doing this for some time. Those all have various levels of sophistication in how they do it. But what I think is interesting is that traditional lenders have been more reluctant to adopt these approaches and tend to rely much more on either traditional credit scores or on human-based decision. Now I'll let Abby share a little bit more about the mechanics of how it works.
Yeah, happy to talk about it. So historically, credit scores have been the main driving decision factor behind lending, and small businesses especially. And like Philip was saying, lenders are starting to find that credit scores are not the best way to capture the value of a borrower. We've found that by looking at really complex patterns in bank transaction history, we're able to actually see and predict whether or not a borrower is likely to default on a loan and whether or not they can afford a new loan. So for Lendio's use case, we have a SaaS product called Axis that is a SaaS product that we sell to lenders to help them automate their underwriting process. And we do this using bank transactions. So rather than looking at a borrower's credit scores, we look at their bank transaction history, their recent bank transaction history, and identify whether or not they are a risky borrower to lend to. We do this by classifying their transactions, creating a borrower P&L, and then evaluating all that information against a credit policy. And this is really made possible by data science and large-scale computing. Credit scores were invented during a time when a person needed to be able to just sum it up to one number so that a human being could process that one number. But we have technology now where we can process really complex patterns in large amounts of data. And so that's what we're utilizing here.
Thanks, Abby, for clarifying that. So you mentioned evaluate against credit policy. So what specific data points are being analyzed to assess the credit worthiness of small business borrowers? And how accurate are these assessments?
Great question. So the main data points that we use are processed using the past 90 days of bank statements or income and expense patterns. We map every single transaction that's come through the bank into categories like deposits that are revenue, deposits that are non-revenue, third-party debt service, as well as doing some machine learning to look for specific types of patterns within those categories. We look for non-sufficient funds charges where borrower ran out of money on their account on a specific day. Those are particularly predictive of whether or not the borrower is likely to default on a loan in the future. And we also look for suspicious activity. And we found that by processing all of this data, we're really able to quite accurately predict which customers are likely to default on a future loan, as well as identify how much of a loan the borrower can afford to take out.
Okay, thank you for your answer. So now tell us a little bit more about this offering, how they are used by lenders to help more effectively target the borrowers.
Yeah, absolutely. So I think it's well known that lenders have struggled, traditional lenders in particular, on how and what to market. The concept in the industry is called next best product. And I would say in the consumer world, next best product has evolved and things have gotten better. If you look at it from the standpoint of your personal finance life, if you're an Amex customer, you've probably at some point in the last year or two received an offer for a personal loan of $25,000 or $50,000. And this is based on your transaction history. They see that you're paying your bill off every month, that you're typically doing, $1,500 to $4,000 worth of transactions, and this is the product that's appropriate for you. And you actually see the same in, to a lesser degree, in the mortgage space. So, I guess many of us who are locked in at low rates now are often receiving, suggestions that we refi, not because rates are good for us, but because they're good for lenders. And we're seeing, HELOC promotions and so on. But all of this is targeted based on data that the lender has about you. But the challenge has been that those techniques have been evasive in small business lending. And so when lenders want to reach out to depositors, they don't quite know what to say or how to say it. And instead you offer, hey, why don't you come in and look at this loan product? But what if there's a different way of doing it? Using the techniques that Abby was just describing, we can actually apply that analysis directly to an existing depositor of a financial institution who actually hasn't requested the use of a lending product. So we go through deposit transactions with the approval of a financial institution, it's their data, and go through and classify transactions, create a borrower P&L, evaluate against the credit policy, the same things that Abby was mentioning, and then proactively offer an up to loan amount to the borrower. That application is very, very simple because the depository institution already knows a lot about the depositor and potential borrower. And so the amount of data that's required in the application is very minimal. Let me ask Abby to share a little bit more about how we're doing some of this in the Lendio marketplace.
Yeah, so the core behind Lendio's marketplace is data science and data algorithms that match our borrowers to lenders. So Philip mentioned earlier that we have about 75 options, 75 different lenders that we work with. And so that's pretty overwhelming for a borrower to have options with every single one of those lenders. So it is one of our core parts of our marketplace where we identify which lenders are the best fit for that borrower and vice versa, right? We want to make sure that the lender is happy with the borrowers that we send them, and that the borrower is happy with the offers that they see. So we use data science, we use the bank transaction, then the application data that we receive when a borrower applies, and we match them to ensure that the offers that they're seeing really meet their needs. We also have matching for other products for borrowers who are not eligible for any capital, such as legal services, help form an LLC, or credit repair services. So even for people who aren't eligible for capital right now, we're still looking for ways and products to help them get to that point.
Thank you, Abby. So how is Lendio actually addressing the unique needs of small business borrower in terms of loan customization and flexibility?
Yeah, so Lendio is really a leader in this space because we are able, unlike a traditional bank, to customize the experience that the borrower goes through by sourcing relevant applicant data. And we can, like I was just talking about, take that data and ensure that they see the different products that they're interested in. Whereas a traditional bank might only have 10 different products, we have 75x10 different products that a borrower could be eligible for. So it really becomes customized and it's simple, where a borrower can come in and apply one time and receive, have a great experience where they receive offers from multiple borrowers. The application is dynamic to the business's needs, and as the data is entered, the application actually changes. So we ensure that the borrower has a good experience where they are not asked to enter data that's not relevant to them or not important for us to make the decisions. So the marketplace really provides a lot of options and a lot of, again, I said, a lot of customization. There's support for a wide range of industries. We have diversity of lenders that are fintechs, regional banks, and CDFIs. We have a range of loan product types. It really just is a much more flexible and custom experience than just going to a traditional bank because of the many options that we have.
All right, thank you, Abby. So now, what impact are digital lending platform having on traditional lending institution? And to complete my question, I would also say, how are they adapting to remain competitive?
Yeah, so before we go there, I'd maybe just follow on a few of the things that Abby was just referencing, and I think it's really well publicized that we had more than 10 years of digital adoption in the first 6 months once the pandemic started. And so I think, we all experienced that in our personal lives where, it's been easy for many years to get a credit card. Home mortgage is getting easier. Obviously, e-commerce is at the forefront of this. But small business lending has really lagged. And the application process is static to the needs of a borrower, and the data that's required in the application is extremely complex, and that's resulting in the need for humans to step in and support a borrower. So we think that some of the advancements that we and others have made in developing technology that is flexible to the borrower's needs, as Abby was just referencing, and then ingesting into an auto decisioning engine for underwriting are really transformative capabilities in this space. So I guess to kind of continue on that and follow on your question, Arnaud, the data that's required to drive underwriting is the next piece. So if you think about it in a chain, you've got applicant supplied information, you've got third-party information that's going to come from other sources, and we'll talk about that. And then all of that has to go together into an LOS for decisioning. But let me just kind of tie those things together. So yeah, the core borrower user experience is great, and it's extremely important because we all know in this industry we have a very high drop-off rate in terms of uncompleted apps. We also need to simplify the uploading of data and the accessing of third-party data. So how do we access bank account and transaction data? So one way, of course, is a bank account statement, but then what do you do with that? Well, the easiest thing to do if the borrowers insist on sharing the data in that manner as opposed to an aggregation is to use an OCR technology to pull it in. And then getting the data preferably from a third-party source like a Finicity. Sourcing the credit bureau data, which I think is a pretty well-established solution in the space, and then doing business and entity verification. So that's going away to a LexisNexis or Dun & Bradstreet or CBFE going and sourcing information. One other one that Abby has been leading some work on is, and some other colleagues here at Lendio, is on industry verification. So for these fintech lenders, and I think all lenders, it's really important to figure out how to verify the industry of the borrower. So this is a big friction point because borrowers often self-select an IX code or other type of identifier and often accidentally misrepresent the type of business they're in. I think occasionally it's intentional, but most often it's accidental. And so humans end up verifying this. And this is yet another place where technology is really transformative and there are solutions out there to go in.
Okay, thank you, Philip, for yes, again, your insights here. That's very interesting. And are there any potential risk associated with the increased use of automation and machine learning in the lending process? And I'm asking that because I'm referring to decision making or the fact that we have a reduced human oversight.
I love this question. As a data scientist, I think it's the right question that this industry needs to be asking, right? So there are definitely risks introducing machine learning into an industry like lending and finance. Lendio is not a lender, right? We are not making decisions about who gets access to what credit. And I'm glad that we're not a lender because that is a much harder job as a data scientist. There are a lot of ethical issues there. And I think that there will be more regulation upcoming in the future where the industry will need to be more regulated as they implement models and data science, machine learning around who gets access to credit, because there definitely is risk there. Again, Lendio is not working in that space. There are benefits to the automation and use of data. There was a really great NYU economics paper that I love to reference that these NYU professors took data from the PPP program, publicly available data, as well as some data that Lendio provided to them from our internal sources. And they were able to demonstrate in this data that the more automated a bank or lending institution was, they actually reduced racial bias and widened economic inclusion. So when the process was more automated, when there was less human interaction, there actually was more opportunity for these people who had been historically discriminated against. So there are definitely risks when it comes to machine learning in lending and finance, but there are lots of opportunities and positive outcomes to using automation and data as well.
All right. Well, thank you, Abby and Philip, for your great insights and sharing your perspective regarding the advancements of technology to better serve the small business lending. Philip, I would like to ask you now, before I let you go, can you please share with us and with the audience where they can find more information regarding your platform? Because I think that was something that you kind of give us today, like we want to know more now how we can access to that.
Thanks, Arnaud. Really appreciate you having us. We're deeply passionate about these topics where you see the intersection between data science, digital innovation, and small business lending. At Lendio, our motto is to fuel the American dream, and we really feel strongly that advancements in small business lending create a huge opportunity for economic growth. If you all have follow-up questions, you're welcome to reach out to us at lendio.com or reach out to me directly, philip@lendio.com.
Well, thank you again, Abby and Philip, for being with us today. And so for us, let's meet at the next Advancio Tech Talk that will happen in the next months. Thank you, everyone.